Don't hang up on AT&T yet, folks. Quarter 3 earnings yesterday, and AT&T finally killed it. It's kind of what I thought all along. I wouldn't say they killed it, but they had a really good earnings report yesterday. Full disclosure, I do own AT&T stock. I now own 75.85 shares of AT&T. Average cost of $29.45 at a market value of $2,113. It's one of my biggest holdings. It is 13% of my portfolio diversity. Don't make fun of me that it's such a big holding. I'm just starting my dividend growth portfolio, so I'm just starting to, figure out what I want allocated everywhere. I am going to get a $26 dividend payment from AT&T, and that's based off 50 shares because I actually just bought more shares after the dividend date. So in this video, I want to go over AT&T's quarter 3 results and discuss why this quarter 3 report really solidifies why I love this stock even more. So let's check it out. Okay, so this is the slide deck published by AT&T Inc. in conjunction with their 2020 earnings call. So we're going to enlarge this and take a look here. Okay, it's just the front page. This is just some cautionary language concerning forward-looking statements, kind of some blah, blah, blah I don't want to read. Okay, so this is the business priorities. Top thing, focused on market-based priorities. 5G wireless and fiber-based connectivity, expanding reach of software-based entertainment platforms. That would be HBO Max, which that launched in May of 2020. Relentless commitment to customer experience, being effective and efficient in everything we do. Transformation efforts ramping. That's another thing I like to see. This company, I don't think they're rebranding, but I think they're re-identifying their brand, and they're trying to come into the more future, into the more future markets, and they know that they have to transform and they can't just be who they've always been. Improving customer experiences with evolving customer needs. That kind of goes hand in hand with streaming and 5G, I think. Positioning company for post-pandemic environment. Again, obviously have to get ready for what life's going to be like after the pandemic is finally over. Improve balance sheet and deliberate capital allocation, investing in strategic growth areas, 5G wireless, fiber, and HBO Max. Good to see that they are growing those areas. Committed to supporting dividend, solid 36-year record. Obviously, as a dividend investor, that's what we want to see, supporting the dividend and a 36-year record. Further debt reduction. Again, everything on this quarter 3 report it's good news, in my opinion. Further debt reduction. Focus on metric improvement. They're trying to pay down debt, and I think they were like in $156 billion worth of debt, so they're starting to pay it down. They're beginning that transformation period where they want to be a completely profitable company. Continued portfolio review. That's just, looking at their, like it says here, non-core assets and making sure they're making money off them. So, quarter 3 results here. Executing market-focused strategy with their strong connectivity results. Third quarter of 2020, subscriber growth in wireless and fiber broadband. 1.1 million postpaid net adds, including 645,000 postpaid voice. 357,000 fiber net adds, including 158,000 total broadband net adds. And here's what I really like to see. Total HBO and HBO Max domestic subs top 38 million. So that's in the US, it's 38 million. And 57 million worldwide. And then it says HBO Max activations have more than doubled in the third quarter from the second. Which obviously, the second quarter was kind of obviously lower because they just launched it in May. But this is really good to see that it's actually taking off. I personally was kind of skeptical on HBO Max because I kind of thought, how are they going to compete? With Netflix, Hulu Plus, Disney Plus, I didn't know how they were going to compete, but right here it kind of shows me that they're edging a corner of the market. Let's see. Next is being effective and efficient in their business transformation. Optimize sales distribution through innovation. That shows me that they're changing how they make their sales distribution to further monetize. Aligning resources to market focus areas, continued cost management. COVID impacted all segments, obviously. Deliberate capital allocation, improved cash flow, significant debt management. Here's another great thing to see. Since the first quarter of 2020, they reduced or extended $30 billion plus of near-term maturities. Expect 2020 free cash flow of $26 billion or higher, with a dividend payout ratio in the high 50%. So, with a dividend payout ratio in the 50 percentile, even then they have enough money to reinvest in the company while also maintaining cash flow and paying out their dividend. And again, they said committed to investing in strategic growth areas, like they said earlier. So here's kind of some charts. Broadband connectivity, postpaid phone subscribers, down a little bit from third quarter of 19, but their net adds from third quarter of 19 is up from 101,000 to 645,000. Asterisk here says 151 from KAC paying accounts. Another good thing to see, fiber subscribers has been steadily, gaining across the quarters, even during the pandemic. Since the third quarter of 19 through the fourth quarter of 19 and all the way through to the third quarter of 20, it's gone from 27% to 33% penetration. 4.7 million subscribers in third quarter of 2020 now. They added they went from 318,000 in third quarter of 19 to 357,000 in the third quarter of 2020. So steady growth means more revenue. Obviously, with it being fiber subscribers, great to see. Software-based entertainment, which is domestic HBO and HBO Max subscribers. In fourth quarter of 19, it was at 34.6 million, declined into the first quarter, and ever since the first quarter, it's been at a steady uptrend. Just an asterisk here. HBO Max launched at the end of May 2020. So third quarter of 2020 includes 28.7 million subscribers with access to HBO Max and 8.6 million HBO Max activations. Premium TV losses, here again, another thing good to see. Third quarter of 19, their losses in their premium TV was 1.1 million, and it's slowly been going down over the next three quarters. But then when we hit third quarter of 2020, we see that they really put a focus on it. Now they're down to only losing $590,000 in third quarter 2020. It's great to see. Here we go to the financial summary. We see that the adjusted earnings per share from third quarter 19 to third quarter 20 is down a little bit, but we obviously know that reason, and that is because of COVID. I mean, the whole world's gone through a pandemic. I mean, I would say that almost every company has had an impact. Some companies have recovered and even over recovered since the pandemic started, but some companies are still quite a ways behind. I would say AT&T's in the middle. They're not way behind, but they're not over recovered. Adjusted earnings per share of 76 cents, like we said. COVID impacts of 21 cents, with 2% from incremental loss and 19 cents estimated revenue-related impacts. Revenue of $42.3 billion. Mobility, broadband, and business remained resilient. Estimated COVID impacts of $2.5 billion. Strong cash flow, $8.3 billion of free cash flow, and $19.8 billion, that's year to date. So overall this year, $19.8 billion cash flow. Quarter three added $8.3 billion. Year to date, dividend payout ratio approximately 57%. Like we said, still plenty of room there. Expect 2020 free cash flow of $26 billion or higher, with a dividend payout ratio in the high 50s. Like we said, full year gross capital investment on track for $20 billion. And here's the communications segment. Strong wireless performance driven by network quality, FirstNet benefits, and bundling. Strong subscriber growth. COVID impact services, obviously, for around 300 million or 450 million, excuse me. Excluding COVID impact, service revenues and margins would have grown. So, without COVID, obviously, this company would have been on the uptrend, but I think kind of COVID helped this company a little bit open its eyes to where they needed to focus what the future of this company was going to be. Not saying that it's a good thing this happened for this company, but I think it helped them kind of figure out where to go next. Focused on fiber broadband growth and cash generation from video. Stabilized broadband revenues with mix shift to fiber. Premium TV net loss of 590,000 with lower churn from higher quality base. EBITDA affected year over year by higher non-cash impacts at approximately $200 million in COVID. From $200 million impacted from COVID. Continued stability in revenue and EBITDA trends. EBITDA stability with cost management actions. Strategic revenue growth continued. And legacy product revenue trends improved. Their legacy products would be their kind of their beginnings, I would say. That would be their landline or their fiber base kind of stuff like that. Stuff that they've been doing, not that they're trying to get into. Here's their Warner Media segment. Revenue down a little bit. Obviously, again, COVID. Estimated $1.6 billion in revenue and $1.1 billion EBITDA impact due to COVID. Higher advertising revenues and costs from sports shifting into third quarter of 2020. So, sports coming back. They have gotten a little more ad revenue, which is always good to see. HBO Max investment drove subscriber growth and activations more than doubled, like we said earlier. Approximately $600 million investment in the third quarter of 2020 and $1.3 billion year to date. Industry content leader led industry with 38 primetime and 15 news and documentary Emmys, which is kind of a tidbit. Subscriber trends improve in Latin America segment. So Mexico wireless net additions of 441,000. So that's good to see. They're going into Latin America more. Capital allocation and liquidity update. Debt management and non-core asset monetization. Strong cash flows support debt reduction and dividend payout ratio. Net debt is at $149 billion, down from $180 billion. So they're paying down debt. They're starting to really focus on it. Dividend payout ratio of 45% in third quarter 2020 and 57% year to date. Proactive debt management provides flexibility and sufficient liquidity. Around 50% reduction in maturities over the next 5 years. Provides flexibility and manageable near-term debt towers. Overall weighted average maturity of 17 years at 4.1%, improved from 13 years and 4.3% at first quarter 2020. Approximately $10 billion cash balance at the end of the third quarter of 2020. So we see here in June 14th of 2018, they were at $180 billion of debt. They paid $9 billion down in by the end of 2018. 2019 they paid down $20 billion, and even with the pandemic happening, they've been able to pay down $2 billion since the third quarter of last year, third quarter of 19. So that's good to see that they still had enough free cash flow to pay down debt even through a pandemic. Strategic review and monetization of non-core assets continue. $3 billion plus in asset sales announced and expected to close in the fourth quarter of 2020. Includes CME, Puerto Rico, expected to close in October. And that is it for the earnings. So, as an owner in this stock, as a shareholder, I guess, even though it's only 70 shares, I'm considered a shareholder. As a shareholder, that was great to see. I was getting a little concerned because, like this says, AT&T was on a 10-day losing streak. On a 10-day losing streak right before the Q3 earnings. Bad news. I was really getting concerned, like, this is never going to come back. I honestly thought, a couple weeks ago was the last time you were going to get it under 30, and boy, was I wrong. But we're still able to get it under 30, but at least it's not at 26. It would have been nice to get in at 26, don't get me wrong, but it's good to see that 5.8% gain yesterday. Best day since April. This is a article about analysts and what they have to say about kind of their price targets for AT&T. It says analysts are generally reiterating neutral to positive views, pleased by subscriber results, but still concerned over a slow uptake on HBO Max and declines in the satellite TV business. But AT&T has, been rumored, and I'm pretty sure it will happen. They're going to get rid of their satellite TV business with DirecTV. Bad business move, but at least they're trying to move forward with it. It says Goldman Sachs is at a neutral rating. It had praise for resilient free cash flow and highlighted improved subscriber momentum. It has a price target of $27, and the current price is $27.85, but at the time of this article it's $27.96. JP Morgan's still kind of neutral, but it has a price target of $34. That's a pretty good jump. If you got in at, say you got in right now at $27.85, that's about $6.15 per share, which would be a solid gain plus your dividend. It expects positive subscriber trends to maintain into the Q4, though it thinks cash flow will be an investor concern after 2020 affected by temporary factors. It also expects a benefit to HBO next year from an initiation of ad-supported video on demand. Guggenheim came out as the most bullish with a $38 price target, implying 36% of upside potential. It's upbeat on the subscriber gains and believes the free cash flow guidance is solid, and there was a fairly strong EBITDA result from the media business, it says. The firm is raising estimates for Q4 revenue and says 2020 free cash flow expectations are in line with revised guidance. So, is T poised to soar? I think so. I can't click on that and look because that's premium stuff, but I think it is. I'm no analyst. I'm no financial advisor. Don't go to the bank and take out a loan and go buy the stock or something based on my advice. But, I hold it. I like it. I'm not selling it, and that's my opinion on it. But anyways, that's pretty much it. I just wanted to, talk about AT&T and maybe just convince myself that it's a good stock to hold, I guess. But yeah, anyways, I'm going to end the video here. Be sure to like and subscribe if you made it this far, and appreciate you. Peace.